Good morning, grab your coffee, settle in, and let's talk about that number you've been polishing for years. You know the one, the 3 digits that supposedly represent your entire financial soul. You've been told that a 750 or an 800 FICO score is your golden ticket, the ultimate shield against high interest rates and the key to the American dream. But here's the deal. While you were watching that number, the rules of the game were quietly deleted and rewritten by an algorithm you'll never see. We're entering the era of the shadow rating. It's a $40 trillion shift in how money moves. And honestly, it's the most interesting and slightly unsettling story in finance right now. Think about it. Total US household debt just hit $18.80 trillion. That's a record high, driven by persistent inflation and a mountain of invisible buy now, pay later credit. When debt gets that big, the old ways of measuring risk start to break. The math stops working. And when math stops working, lenders start looking for a new yardstick. Enter FICO 10T and Vantage Score 4.0. They've achieved 100% GSE compliance, which is a fancy way of saying Fannie Mae and Freddie Mac are now mandatory fans of trended data. It's not just about whether you paid your bill last month anymore, it's about the trajectory of your life. You might have an 800 score today, but if the algorithm sees your spending habits shifting, that perfect number is suddenly secondary. You're being bypassed by a behavioral engine that might price you higher than a neighbor with a 600 Eddy score, just because their digital life looks more predictable to a machine. Let that sink in. Your legacy score is becoming a relic. Here's where it gets strange, and this is the part nobody's talking about. If the number we've spent decades obsessing over is no longer the primary filter for our financial worth, what exactly is the new metric? If the world's largest lenders are quietly moving the goalposts, what does that tell you about the value of your financial reputation tomorrow morning? So let's go under the hood. How does this actually work? It's called behavioral equity, and it's fueled by a data harvesting machine that would make a spy agency blush. We're talking about 2.5 petabytes of data ingested every single day. To put that in perspective, that's about 500 million songs worth of data about you, your habits, and your digital footprint processed every 24 hours. This has fueled a global AI credit scoring market that's already worth $108 billion, a 112% jump in just 3 years. Now you might be thinking, wait, isn't my bank data private? Well, look at Section 33 of the Open Banking Regulations. It effectively mandates the sharing of consumer transaction data. Lenders aren't just looking at your balance anymore. They're looking at your behavioral telemetry. Are you checking your banking app at 3 a.m.? Do you pay your Netflix subscription on the first try or the third? How many times a week do you order takeout when you're supposed to be saving for a mortgage? Every digital footprint is now a data point in what I call a digital personality test that never ends. I know, it sounds like sci-fi, but it's happening right now. Major retail banks have already automated 90% of personal loan approvals. They've reduced manual underwriting by 60%. Why? Because the machine is faster and it claims to be smarter. It looks at your consistency, your reliability, and your lifestyle metrics. It's looking for behavioral equity, the idea that a person who buys high-quality groceries and goes to the gym regularly is a better bet than someone with a high income but erratic spending patterns. That number blew me away when I first saw it. A 300% increase in data harvesting volume since 2022, it's a literal explosion of information. But here's the catch. The machine isn't just looking to help you, it's looking to price you. This is where algorithmic pricing comes in. These behavioral flags are being used to justify risk premiums. Even if you have that shiny 800 FICO score, if the AI thinks your lifestyle looks risky, you might end up paying an extra 0.5% on your mortgage. On a $500,000 house, that's not just pocket change. That's tens of thousands of dollars over the life of the loan. Let that land. We've moved from a system of "did you pay?" to a system of "who are you?" And who is actually holding the stopwatch in this race for your data? And why are they winning? Let's zoom out for a second, because this isn't just a local phenomenon, this is a global web. While we're focused on traditional banks, the real power has shifted to the shadow credit market. These are non-bank financial institutions, NBFIs, and they are currently sitting on $65 trillion in assets. That is a massive number. To give you some context. That's more than the total private credit volume of the traditional banking sector. It's a $65 trillion ghost in the machine. And here is the part I find wild. 86% of US mid-market lending has shifted to these private, AI-driven platforms. These aren't the banks with marble lobbies and friendly tellers. These are tech firms using information asymmetry to win. They know things about the market and about you that the public standards haven't even thought to ask. They're identifying low-risk profiles that the FICO system misses, and they're charging risk premiums on high FICO, individuals who show erratic digital behavior. It's a massive arbitrage play. Imagine you're an elite athlete, but the scouts aren't looking at your game tape anymore. Instead, they're monitoring your sleep patterns, your heart rate during practice, and what you eat for breakfast. That's what the shadow credit market is doing to your finances. They've realized that the traditional credit score is a lagging indicator. It tells them what happened yesterday. They want to know what's going to happen tomorrow. And they're willing to bet $65 trillion that their algorithms are right. This shift to private AI platforms has fundamentally changed the landscape. It's no longer a level playing field where everyone knows the rules, it's a black box. If you get denied a loan or hit with a higher rate, you can't just call someone and ask why. The answer is the algorithm saw something. What did it see? Maybe it saw that you stopped shopping at a certain premium grocery store. Maybe it saw that you started using your credit card at 2 a.m. more often. In the world of shadow credit, everything is a signal. It's a fascinating, if slightly cold, evolution of capitalism. But here's the kicker. This new system we're talking about, it's actually 185 years old. The technology is new, but the philosophy is a ghost from the past. If the boundary between our lives and our loans is disappearing, who really owns your financial reputation? Let's take a trip back to 1841. A man named Lewis Tappan started the Mercantile Agency. This was the precursor to Dun & Bradstreet, and it was the world's first real credit bureau. But Tappan didn't have algorithms. He had spies. He had a network of correspondents who would monitor the moral character of business owners. They'd report on whether a merchant was a good Christian, whether he drank too much, or if he was known to be extravagant in his personal life. They called them character reports. Fast forward to 2026, and the AI has replaced the spies, but the mission is the same. Your smartphone telemetry is the modern equivalent of Tappan's correspondence. The machine is monitoring your digital character. Now, there's a bull case for this. Some people, like Upstart CEO Dave Girouard, argue that this is the ultimate tool for financial inclusion. There are 33 million thin-file consumers in the US, people who are traditionally unbankable because they don't have a long credit history. And AI models can now score them using behavioral metadata, giving them access to credit for the first time. That's a massive win for social mobility. But then there's the bear case. Rohit Chopra, the director of the CFPB, has been sounding the alarm on what he calls digital redlining. He warns that these AI models are black boxes that could automate bias. If the algorithm decides that people who live in certain zip codes or shop at certain stores are risky, it could quietly cut off entire communities from affordable credit without anyone ever knowing why. It's the end of financial anonymity. Every life choice you make is now a potential financial penalty. It's a delicate balance. On one hand, we're seeing a 15% reduction in the number of unbankable people. That's millions of lives improved. On the other hand, for the general population, the cost of a slip-up in your digital life is higher than ever. As the boundary between our lives and our loans disappears, we have to ask, are we building a more inclusive system or just a more efficient cage? How does this character score actually hit your wallet tomorrow morning? All right, let's wrap this up with the bottom line for your wallet in 2026. The era of the three-digit score is effectively over. We've seen a 25% lift in predictive accuracy thanks to these AI models. For lenders, that's a miracle. It means they no longer miss a beat. They can price risk with surgical precision. But for you, the consumer, it means the cushion is gone. The days of hiding behind a high FICO score while your financial habits deteriorate are over. Look at the mortgage market. Even with AI tiering, the average 30-year fixed mortgage rate is pinned between 6.8 and 7.2%. Why? Because lenders are using AI to protect their margins in a higher for longer interest rate environment. They're not just looking at the Fed. They're looking at you. Your financial health is now a living, breathing digital reputation. It's no longer something you check once a year. It's something you broadcast every time you unlock your phone. This is the 2026 landscape, a world where your interest rate is a reflection of your personality and your creditworthiness is a product of your telemetry. It's efficient, It's data-driven, and it's completely invisible. So next time you go to swipe your card or check your bank app in the middle of the night, just remember, the machine is watching. And it's not just counting your dollars, it's measuring your character. The era of the three-digit score is over. In the world of the $40 trillion shadow rating, your character is no longer a virtue. It's a price tag. Think about that next time you see your grocery bill or your car payment. If the world's most powerful algorithms are judging your every move, what is your digital personality actually worth to them?